So our last video is going to be about how governments or government agencies, in this case the central bank, so the Bank of Canada, Bank of England, the US Federal Reserve, whatever, how they use the financial system itself to try to manipulate the economy through what's called monetary policy. And there's two tools they have, and they're basically the supply of money and interest rates. So before we get started, there's essentially two ways that those two items can be influenced in two ways. So at the end of the day, the central bank is going to try to influence either the supply of money or the demand for money. Ultimately, those two things interact to come up with how much is going to be borrowed in the broader economy, how much is available to be borrowed, how much actually will be borrowed. In other words, the law of supply and demand applies to even money itself, which is why it was the first unit in the course. So either directly or indirectly, actions on the part of central banks are an attempt to influence the supply of money available and how much people want to borrow it, ultimately influencing, therefore, the price of money and the quantity that's actually borrowed, right? The price being interest, right? The rate of interest. So, for instance, the main things the government central banks tend to do is, one, they'll change the reserve requirement. So in the video, the Mr. Clifford video, you saw how money was created by banks withholding 10% and lending out the remaining 90% of any new deposits. So if you hold back 20%, then only 80 can be lent out, 80%, right? So if less can be lent out, less money will be created, reducing supply. You can go the opposite way, you can go from 10% down to 5% so that more money will be created. Now, that doesn't change that how much will be borrowed. Just because you can lend out more doesn't mean people will be banging down your door to borrow. That's a different case, right? One of the ways you can influence how much money is actually out there is by central banks going and intervening in a very market-friendly way in the actual bond market or the money markets, and actually buying financial securities from the general population, from companies and from individuals. So the central bank will take its money or create the money and buy these things. And of course, those individuals now, instead of having the certificates or those financial securities, have the cash, which they then put into regular banks, which then allows those banks to loan out more money, right? People then go and borrow that money, hopefully, spend it, increasing aggregate demand and therefore increasing GDP. Get it? The second thing they do, so the main thing they will do is they'll go into open markets and they'll buy financial securities like that. The second thing they'll do is they'll change the reserve ratio up or down as needed. The third thing they can try to do is a combination. They tend not to do it as much of those things. The third unique thing they can do, though, is switch government deposits around. The main two, though, that they've been up to lately in the last decade or two is either changing the reserve requirements or capital requirements of banks, or two, going into the open market, financial markets, and buying financial securities. It's called open market action. So what I want to do is take a look at the effect of central banks being successful in terms of either influencing supply or demand for money and therefore ultimately interest rates. So how does this actually happen? In other words, how is GDP affected? So for this whole scenario, let's say interest rates are dropped. So maybe what happens is supply is increased of money available to be borrowed, meaning to get people to borrow it, banks have to drop interest rates to entice them to borrow more. More is available, prices fall, right? So interest rates fall. Fine. So up here you have savings and borrowing. So what happens when interest rates fall? What's more likely to happen? More savings or less? Well, you're going to make less in the bank, so why would you save it? Let's spend it, right? Let's put it somewhere else. So savings, down. Well, if savings are down, what are people doing with it? Oh, they're spending it. So consumption is up, right? If you don't save it, you're spending. So government consumption by businesses, consumers, and governments is probably up. If interest rates, so borrowing, are you more likely to borrow? It's the next one, right? If interest rates have gone down, are you more or less likely to borrow than you were before? Well, it's cheaper now to borrow, so borrowing likely goes up. What do you do with borrowed money for the 800th time? You spend it. So interest rates being lower means people are more likely to, one, spend their savings, two, borrow money and spend more, and three, they have more disposable income to spend because if they had debt already, the interest they were paying on that debt has now shrunk, leaving them with more money to spend. So 3 main reasons why a reduction in interest is going to lead to more spending. Consumers, same 3 apply. Government, same 3 apply. Governments have lots of debt. They now have less interest. They'll spend it. Also cheaper to borrow more. They'll spend it. Investment spending, same thing. Businesses will have more money if they have debt. They have less interest payments. They're more likely to borrow because interest rates are lower. There's no reason to save because they're not making any interest. That leads to more spending. Exports and imports, more complicated, but the effect will be with lower interest rates in Canada relative to the rest of the world. Remember how this works? Complicated. Lower interest results in our lower currency for us, which means we can sell stuff cheaper to foreigners and our imports are more expensive because our dollar buys less. So exports are up, which raises GDP, and imports, more expensive, they're down, but that lowered GDP. So we've shrunk something that shrinks GDP, which raises GDP, double negative, right? So that's how interest, if things work as planned, can be used to manipulate GDP. Think about it as this. Money is the blood that flows through the economy, just like the blood that flows through your veins, right? If there's something wrong or sick with your blood, like a blood disease, every organ in your body doesn't function properly. You feel terrible. Well, anything that affects money will affect the entire economy. And interest is the price of money. So anything that affects interest will impact the demand for money, and that will affect the economy. That's what monetary policy does.